Okay, this video is going to be on market structural shifts, specifically the transition phase from one state of a market into another. And it's going to use the British pound futures as an example. It's a trade that I'm currently in right now. And then also I'm going to give a little bit more information on stacking positions when you are, correct. So primarily, there are two ways to signal or to confirm a market structural transition. One is extremely aggressive using the execution time frames, the 5 minute and the 1 minute, based off the system I use, and the other is used off of the 4 hour time frame. The one I'm going to go over, or actually I'll go over both, just because, why not? So on GBP, or 6B, sorry, what we have currently is a response from a liquidity point, a previous liquidity point, which is here in the daily. I've talked about this in the Outlook, so if you haven't watched that, please go back and watch the Outlook. I believe it's 5.2 of 2026 before you watch this video. But anyway, we're assessing the response that is occurring, or the action that is occurring after mitigating or purging this daily liquidity point here. And so what I had discussed in the Outlook 5.2 previously was there were two actions. There's only ever two actions that can occur at a liquidity point. It's a break of structure or a draw on liquidity. And the action that I was looking for was a draw on liquidity. There's two ways to confirm a draw on liquidity. Well, how do we do that? The first way is from the 4 hour time frame. This is just the time frame that I use to analyze charts. So I use this to analyze the 4 hour structure, pre-liquidity draw and post-liquidity draw, to determine if we have aptly transitioned from bullish price action in this case into bearish price action. So this is the conservative way to confirm a liquidity draw, the action of transition in this particular case. And so the steps are: one, pre-liquidity, at the onset of the liquidity draw or proposed liquidity draw, we need to look at the market before the liquidity draw and then after. So how do we link the two in order to confirm this? Once the liquidity draw occurs, that's delineated by this line here. The first thing that I want to do is identify the most recent or the last structural point or liquidity point of the subsequent or predecessor price action. And so because we have bullish price action, I want to look for the latest highest low, the latest higher low. And that just so happens to be here. Now, how we define the lows is based off the smileys and the frowns. Not even going to talk about that, but this is the highest low. So in order to confirm the liquidity draw, I need to see the price action post the liquidity draw. So all the price action that happens to the right side to continue lower, to break structure, to perform the action of a BOS at this liquidity point. If that occurs, then the transition is complete, or the transition is confirmed, and then we need to look for executions based off of the response after the break of structure, assuming that there is inefficient pricing generated, which it seems to be will be the case. That price will then pull back and give us opportunities to enter to continue towards lower liquidity points. So once again, this is the very conservative way to confirm a transition based on the action of a liquidity draw. And that's first looking at firstly, the liquidity point that we're looking at to mitigate. Then we want to look at the price action pre-liquidity draw to identify the latest or the most recent liquidity point or structural point that needs to be assessed for an action. That's here. And then post-liquidity draw, we don't want to see price continue, in the direction of the liquidity draw. If that does, then it's a break of structure. But because it's a liquidity draw, what we would like to see is price to continue down towards that low and then perform the action of a break of structure, not a liquidity draw. Because if this were to purge and revert similar to what's happening here, then we would be looking for a transition actually at this low to continue price action to move higher. And we don't want that. What we want to see is this transition from bullish price action into bearish price action, and then to look something like this. Very, very vaguely, very rigid here, but then we would look for this pullback and that. And that's generally what we create. What we have a high, a low, a high, a lower high, and then a lower low. That's the price action we want to see that will confirm the transition. And that's conservative based off the 4-hour time frame. And why I say it's conservative is because it's going to generate a lot of data over however X amount of time to confirm this. But usually the benefits of using the 4-hour to confirm this transition will be that the data is supporting and the volume is supporting that based off of the amount of orders that are inside of these candles. Now, the aggressive way, which is where I entered on my opportunity here, is to do this exact same thing using the exact same process, but on the 5-minute or my execution time frame, 5-minute or 1 minute. I usually like to use the 5-minute because it captures most of the opportunities that I would like to look for. So doing the exact same thing where we want to look at the price action pre-liquidity draw and then post-liquidity draw to confirm our setup. So if this is the exact same liquidity point, the exact same draw on liquidity here, just represented with 5-minute candles, this is what that price action looks like. I want to assess the price action before that liquidity draw to identify the most recent high or low. So before it. And then I want to wait for the price action to break structure to confirm the liquidity draw. This is very aggressive because this is not the same amount of data that is represented on the 4-hour time frame. And if you want to do the calculation, you can calculate how many 5-minute candles there are in 4 hours and so on and so forth. But the more data you have on the higher time, the more candles you have on the higher time frame, they trump the amount of candles that you would have on the lower time frame. But we can debate that, blah, blah, whatever. It's just that using the 5-minute, because you have less candles to assess price action, this is considered aggressive. Whereas if you were to use the 4-hour or the daily or whatever, that would be considered conservative, but it would be more powerful because there's a lot more data supporting the move. Okay. So anyway, we have identified here the low, the most recent low, which is this low here. So I'm gonna get rid of this since we know where it is. This is the most recent low. And so now the price action post liquidity draw, I would like to see be drawn towards this low and then perform a break of structure. Now, the break of structure, immediately here you see that we tap, 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 but we never really drew back higher. Then we ended up actually breaking structure where we closed multiple candles below. And because of this multiple candle close below this low here, that confirms the break of structure to me. And then now that is when I want to execute the liquidity draw model and look for executions. So I'm not going to leave the 5-minute time frame because I'm actually using the execution time frame using the execution time frame to mark up structure, which is really my microstructure, to find opportunities. Now, where I got caught up early on in this trade was looking for opportunities in the immediate after the break of structure. And I've taught my students to not do that. What I always say is when we are looking for either discount or either buys or sells, we want to look and the most optimal or the best possible premium and assess the price action from that way if you're looking for sells, and then the best possible discount if you're looking for buys first, and follow the price action moving down until you spot an inefficiency. And what we're doing here is we're trying to assess the efficient flow of price action. Are the candles mitigated? Is everything balanced? Because all trading is balance. Is everything balanced here? And if there isn't an imbalance, and starting from the very high, and if everything is balanced and then we find the imbalance, that is most likely what I would claim to be the origin of the move, and that would be the likely area price is going to pull back towards to perform an action of mitigation on one of the entry signals that I like to use. And so in this particular case, I got caught up after the break of structure by using this 5-minute price gap here to take an entry, and it did give a valid response, but ultimately you can see that we, drew higher. Now, why is that? Because this is not the origin of the move, and I got caught up in doing what I told my students not to do, is looking for sells lower in the premium than rather than higher. And I did not perform the exact analysis method that I wanted to or should have done. And so in doing so, what I do is now I pull back to the very high, and I want to literally scan every single candle moving down towards the break of structure and stop at the first inefficient pricing area that I see. And that's represented here by this green box. It's a 5-minute price gap. It's also the very highest point in the premium that is unmitigated. And so, as you can see, price ended up pulling back into that 5-minute price gap. I actually entered in at 50% of the price gap and had my stop loss here at the high of the candle. And my target is where my target is. But nonetheless, that is the execution. This is the result. And now the last thing I'll talk about in this video is stacking entries. Now, once you got your initial entry, you have the option of stacking entries, especially if once you've confirmed the transition, you now know that you should be looking for continuation of that price action. And so if I'm looking for continuation of bearish price action in this case, every pullback is an opportunity for me to take another sell position. And so if you're looking at the price action right now, that is exactly what I did. So at this pullback here, right here, I got a position. And then at this pullback here, I got a position as well. I'm not going to go over those positions, but no, that's what I did. And so now I have 3 positions on this trade setup so far, according to the liquidity draw from a macro liquidity point, using an aggressive confirmation based on the 5-minute execution time frame with 3 positions stacked. And then my target is my target, but we're still waiting for the conservative confirmation, which would be taking out this low here. And if that occurs and we do get that break of structure, then the transition will be solidified, and then I would look for continuation, very strong continuation of bearish price action to the downside to clear previous liquidity points. I hope you learned something in this video. Peace.